Welcome to Factful Finance, where we break down complex financial concepts in the simplest way possible. Let's dive into a topic that plays a crucial role in many portfolios: bonds. But before we get into the details, let me ask you, did you know that bonds have been a key tool for governments and corporations for centuries to raise funds? They're not just about lending money, they're about strategy, stability, and opportunity. Let's explore how they work and how they could be a game changer for your financial future. Now, before we start, just a quick reminder. The information in this video is for educational purposes only. The strategies we discuss aren't one-size-fits-all, so it's always wise to consult with a financial professional for personalized advice. Okay, let's break it down. A bond, at its core, is a loan. When you buy a bond, you're lending money to a corporation or government. In return, they promise to pay you interest at regular intervals and return your principal when the bond matures. But it's not quite that simple. The bond market is vast, with bonds varying in risk, return, and structure. Let's explore some of the most important factors to consider. First up, bond types. There are government bonds, corporate bonds, municipal bonds, and more. Government bonds, like U.S. Treasury bonds, are considered some of the safest investments because they're backed by the government. But as with any safe bet, the return is generally lower. On the flip side, corporate bonds can offer higher returns but come with higher risk. Think of them as the high-reward, high-risk players in the bond world. Next, let's talk about bond ratings. Bonds are rated based on the likelihood of the issuer defaulting. These ratings range from AAA, the highest, to D, the lowest. The higher the rating, the lower the interest rate you'll typically receive, but the safer your investment is. In contrast, bonds with lower ratings might offer higher interest rates to compensate for the added risk. Here's a practical example. Imagine you're considering two bonds. One is a U.S. Treasury bond with a rating of AAA, paying 2% annually. The other is a corporate bond from a tech company with a rating of BBB, offering 5% annually. The corporate bond has the potential for higher returns, but you're taking on more risk in the event the company faces financial trouble. This is where understanding the trade-off between risk and reward comes into play. Now, let's touch on bond yields. A bond's yield is the return you earn on your investment, and it's affected by several factors, including the interest rate environment and the bond's price. If interest rates rise, existing bonds become less attractive, which causes their prices to drop. Similarly, if rates fall, bond prices tend to rise. This is important for investors because it affects the total return you'll get if you decide to sell the bond before it matures. But there's more to it. You'll also want to consider the bond's duration, how long you're lending your money. Longer duration bonds are more sensitive to interest rate changes. If you're holding bonds for the long term, you might want to avoid locking in rates that could be lower than future market rates. To wrap it up, let's talk about bond diversification. Just like with stocks, diversification is key to managing risk. Holding a variety of bonds, different types, ratings, and durations can help balance out the potential ups and downs in the market. Here's a quick example. Let's say you're like Noah, a 30-year-old who's building a retirement portfolio. He could buy a mix of U.S. Treasury bonds for safety, municipal bonds for tax benefits, and corporate bonds for higher returns. By diversifying, Noah's portfolio is better equipped to weather market fluctuations. Before we finish, here's a thought. Bonds are a powerful tool in your investment toolkit, but like any investment, they come with risks. It's essential to understand the basics, bond types, ratings, yields, and diversification, to make smart, informed decisions that align with your financial goals. What's the first step you'll take toward incorporating bonds into your investment strategy? Share your thoughts in the comments. Thanks for watching Factful Finance. If you found this helpful, why not subscribe so you don't miss out on more insights that could help you take your financial knowledge to the next level. We think you'll find the next video on screen just as valuable for achieving your financial goals.